Hi, I'm Michael Yardney, and today I'd like to discuss the four common questions we're asked about the state of the economy, our property markets, and what's ahead. And to help me bring some perspective to this session, I've got with me my good friend and business partner, Ken Race, Director of Metropole Wealth Advisory. Hi, Ken.
Hi, Michael. How are you?
Good. Now, we're clearly being socially distanced. We're
Yeah.
doing the right sort of thing. But people are concerned at the moment, aren't they? They're worried, they're uncertain. And it's actually normal to feel that way, Ken.
I think it is, particularly that, can I say, hardly anybody, if anybody, has seen a similar issue. I mean, we've all gone through recessions, a bit of this, unemployment, but never such a tsunami of collapse in economic activity.
Sure. And I guess we all like to have some control of our future, and there's so many uncertainties. Is the stock market going to crash? Well, it has. Is Australia going to fall into recession? Is the coronavirus going to kill the property market as well? These are obviously questions in the minds of investors in light of the economic woes that are going on around the world at the moment. Now, we don't want to downplay the medical issues. There's medical issues and there's economic issues. We're not qualified to discuss the medical issues, but clearly many Australians are going to come in contact with the virus over the next couple of months. Some will just suffer cold and flu symptoms. Other more frail members of our community, unfortunately, are going to get much sicker than that, and that's tragic. And Ken, I'm surprised, but it's spreading so much. I think most businesses are going to suffer as well.
I can't imagine any part of our society that's not going to be touched, and people just have to bunker down and almost hide, which just reduces the activity. People are just afraid to go out to buy stuff. They're putting everything on hold. Even people with money, I've seen, aren't going out there and buying stuff.
So today we want to discuss the four questions that you need to ask to get direction, to get certainty, to get better results through this. So what we're going to discuss today is what's in store for our property markets in the long term. And I think it's going to be important to keep a long-term perspective. We're going to discuss what's in store for our property markets in the short term. What's ahead? I think we all need that to know that too. The question on everyone's mind is what's going to happen if Australia goes into recession? And I'm going to ask Ken to explain that to us. And most importantly then, what should you do in understanding all these circumstances? At the end of all this, we hope to give you some direction. There's so many mixed messages, you're going to want to know what to do next. We're going to give you a level of certainty. No one knows exactly what's going on, but if you've got a plan, then you've got more control of your life. And we're going to help those who are in the position to get better results, to taking advantage of the opportunities now, and those who are struggling a bit, hopefully to improve their outcomes as well. Now, Ken's a financial advisor, so I want to give you this quick disclaimer that we're not giving you personal financial advice. We're not able to do that because we don't know your circumstances. This is general information. Now, most of you would already know Ken and me, but for those who don't, if you've been directed here by a friend, I've been involved in property for well over 45 years. I've probably educated more successful people in property investment in Australia than anyone else. I've written 9 books, 2 of them international bestsellers, but I'm not a theorist. I've built a very successful property portfolio myself. And Ken Race is an accountant, a licensed financial planner, a licensed estate agent. He's actually a successful business person and property investor. Boy, you've been around for a long time and wearing a number of hats, Ken.
That's it. And maybe that's why I've lost so much hair as opposed to it being grey like yours.
What it does do is this gives us the perspective to give you some information. So what's ahead? Let's start with the elephant in the room. The thing everyone's wondering about, are our property markets going to crash? Is COVID going to kill our property markets? Of course, we don't really know. But based on my perspective, having been involved in property for over 47 years, while this issue will have an effect on our economy, clearly, and a short-term impact on our property markets, because consumers are going to become less confident, because they're going to sit on the sidelines for a while, because the government's going to slow down how we interact with property, I believe a year from now, particularly 5 years from now, definitely 10 years from now, this pandemic will have no influence on where our Australian property markets are, where the value of your home is or my home. Now, don't get me wrong, I'm not going to suggest it's going on for 1 or 10 or 5 years. What I'm saying is there will be serious short-term economic issues, but because the underlying fundamentals for our property markets haven't changed, I believe they're going to pick up quickly. But feeling fearful of these extremes, it's fine, it's normal. On the other hand, acting on the fear, that can lead to grave financial mistakes. Sometimes such mistakes that people can't recover. So don't make 30-year investment decisions based on the last 30 minutes of news. I think we're already in a technical recession anyway, but we'll speak to Ken about that in a moment. But I also think we're going to recover in the second half of the year. So why do I say that? Because from my perspective, I've been through not the same, but similar. The Asian bird flu in 2015, and we got through that. Swine flu in 2009, 2010, and we survived that. The global financial crisis came and went in 2008, 2009, and we got through that, as did SARS in 2002-3, September 11th in 2001, we got that. I could go on and on. Remember mad cow disease, remember the recession we had to have. In fact, I remember scares of global cooling before global warming and worries that our planet couldn't provide enough food to sustain our population. But interestingly, this is the first global crisis we're experiencing in an era of social media, and we've learned that information spreads, it spreads fast, but false or sensational information spreads even faster. So remember the words of Warren Buffett. He said, be fearful when others are greedy and be greedy when others are fearful. Now, I know that's easy to say and I know it's hard to do, but let's have a look at what's going to happen in the next little while for our property markets, because I'm confident about the future of our property markets. I'm confident about the long-term future of our property markets based on a number of strong fundamentals. Firstly, we've got strong population growth. Our population is growing at 360, 380,000 people a year. Now, it may drop a bit because immigration may drop a little bit for a short while, but as soon as this is over, we're going to have more people than ever wanting to come to this lovely country of ours. And that's requiring about 170, 180,000 new dwellings to be built a year, but we're not building that. There's currently a declining housing supply. We've come out of a property boom, so there's fewer cranes in the sky, fewer new housing estates on the outskirts. So we're going to have a continuing supply. People are still going to get married. They're still going to have babies. They're still going to move jobs after all this happens, and probably sooner rather than later. Another reason the long-term fundamentals for our property market are good is we're at historically low interest rates. They've never been as low, and the Reserve Bank has told us they're going to remain at this rate for at least another 3 years. So that's going to be good. But despite all this, our demographics is changing. We're getting smaller households, more 1 and 2 people households, young people leaving home, older people are living on their own or in couples. So even for the same number of people, we need more dwellings, again pushing up the demand for property. And property values, our property market is very much driven by supply and demand. But at this sort of stage where the market's a bit uncertain, there's also going to be more people renting. For a long time, close to 30% of our population in Australia are renting, not all because they couldn't afford to buy a property, but it was lifestyle choices. But I see moving forward that up to 40% of our population could be tenants, requiring people like you and me to provide housing for them because the government isn't at the moment. And first homeowners will be back. They started the year strongly. At the moment, if they've got a first home owner's loan or special grants, this is a great time for them to get in the property market when all of a sudden there's a bit of a lull, because they're in it for the long term. And my hunch is that what's going to happen moving forward is that the government is going to give more incentive to first homeowners. That's what happened with Kevin Rudd in the global financial crisis. It's what Bob Hawke did in the 1982 recession we had. It wasn't a depression, because there's a whole lot of multiplier effects. A whole lot of tentacles go out when somebody buys a home because they got to buy televisions and fridges and carpets and things like that. And in general, our property fundamentals are sound and our banking system is sound. Haven't got time to go into all that just here at the moment, but that's why in the long term, I believe our property markets are good. But, okay, you probably accept that as well. The question is, what does it mean for us in the short term? Well, I believe we're going to go into recession, but I'm going to let Ken Race explain that because that's his area of expertise. I believe our property markets are going to shut down for a while. They're going to shut down because the government has asked us to socially distance. They've stopped the normal auctions and open for inspections. If lockdown happens more, very, very likely we're going to have no transactions for 3, 4, 5 weeks. But remember, we have that every Christmas. The 20th of December, the solicitors go on holiday, the banks go on holiday, the conveyancers do, the estate agents go away. So very commonly we have periods of shutdown and the property values don't crash. This time round, though, it may be a little bit longer, it may be a bit shorter. And what will be different this time round is there's actually going to be less confidence in the market when we start up again. But not all markets are going to be impacted equally. I believe the upper end of the market is going to suffer more because when the stock market crashes, the luxury end of the market always hibernates. Buyers and sellers go on strike. And I also see areas where blue collar workers, where areas where people aren't going to be able to do their jobs remotely or by working from home, or where there's more casual workers are going to suffer as well. But I believe suburbs where there are people who've got good jobs, who've got buffers in place, who've got some savings, who've got superannuation, well-located homes in those areas are not going to go down much in value. Now, recently, in fact, only today, I had somebody on the internet send me a question saying, Michael, tell me how much a property value is going to fall. And I said to him, I don't give forecasts. If you followed me for 20 years on the internet, I've been giving my thoughts, but I don't like giving forecasts because they're always wrong. No one knows what's going to happen. So I have expectations. I expect the property market will suffer a little bit, but I don't know by how much. I expect the property market's going to pick up again, but I don't know exactly when. Now, that's not a cop-out. It's a way I think, a way I invest, a way I finance things, the sort of properties I buy to mean that I don't have to have knee-jerk reactions. So things will pick up. And I also believe our property markets will recover quickly because property is an important part of our economy. It employs a lot of people. The construction industry employ a lot of people. And the government is hell-bent on preventing us from getting into a deeper recession than we need to. And it recognizes the importance of residential real estate and construction in the next phase once we get through the difficult times. So currently the government's supporting us in the lockdown. And then as we start to recover, I think, well, I hope the government does what the others have done in the past and help the property industry move on. Because remember, there's going to be fewer buyers in the market, but there'll be even fewer sellers because at any time there's discretionary buyers and non-discretionary buyers. Discretionary buyers are going to sit by the sidelines. You don't need to upgrade your trophy home to a bigger home at the moment if the market's flat. But if you've had a baby, if you've had a divorce, if you've had a death in the family, you're still going to want to move. And there are people who sold a few weeks ago who are currently in limbo. They've actually got to find a new home to move into, or there's people who've bought who've got to sell at the moment. And on that basis, the market will recover at a time when there are fewer properties on the market. And based on that, I can see it recovering pretty quickly. Now, this is an interesting graph from CoreLogic that shows that the property market is very resilient after all those downturns that we spoke about before. So the grey shaded bars are the financial crises, the stock market crashes, and the orange line is really property price growth. And you'll see these little dips when the market goes down, when the stock market goes down, when we go into a recession, and then the property market picks up very quickly. So, Ken, I'd like to ask you, is the coronavirus going to kill the economy? Are we going to go into recession?
Great question, Michael. And I think it's very similar to the current rates of infection, where 80% of people who are impacted mildly. So I think the property market will suffer, but to what degree, and will it bounce back? And given that, I was going to say 70%, but 60% of owners live in their home, that doesn't create the volatility that the share market creates. And because you don't need your stocks and shares, that's why you see those massive ups and downs every time there's something on the front page of the newspaper. So I think you need knowledge so that you're not fearful in this current economic uncertainty. So,
Ken, if I could just interrupt for a sec, because that's a really good point, that the majority of properties, well, there's around 10 million properties in Australia. About a third of them are investment properties. About a third of them are owner-occupiers who have no mortgage at all. And about a third are owner-occupiers who actually do have a mortgage. But most of the mortgage holders are prepaid already. They haven't reduced their mortgages payments when interest rates went down. A lot of them have actually got quite some equity in their properties. And the other thing is that those who have got more loans against them, many of them are against good assets, investment properties. So that's another good fundamental that's going to underpin our property markets. Sorry to interrupt your train.
No. They're excellent points, because when we looked at the GFC, I mean, the share market crashed. Everybody sold out because they didn't know what was going to happen. They didn't know where the floor was. And in essence, it was a bottomless pit of how much money people could lose. So people were trying to mitigate how much they lost. House prices certainly fell at that time, but relatively marginally. And we're actually seeing from the medium house prices at the time of the GFC to now, property prices now are almost, I was going to say 3-4 times, and depending where you are, it could be 7 times higher than what it was in those poor periods. And that's because people come back into the market, they buy their house. So it's those basic fundamentals that you were talking about earlier on that supports the property price. So I'm thinking that there's going to be some reduction in prices. There could be some reductions in rents as well, which means homeowners or investment property owners will need to supplement how much they have to put into the property ownership until this all flushes out of the system. And if we see the previous economic downturns, it flushes out pretty quickly for property, certainly very quickly as relation to other investment types. So for me, you must have had the fundamentals in place. Who will be protected? I'm looking at this as a protection. So people who buy investment grade properties, people who have got financial buffers, people who have got multi-income streams, people who have got a broad range of mentors and coaches. There's a flight to quality in these economic downturns. And unfortunately, a lot of people don't apply those basic economic principles to property because they say property will always do good. Good properties will do good. The large bulk aren't investment grade properties and therefore won't do as well. So I think the recovery will be faster for property than other areas, and faster again for people who have bought investment grade properties and have those basic protection mechanisms in place.
Interestingly, speaking to clients over the last couple of weeks, Metropole clients, I've found they fall into 2 categories. There are some who are quite nervous at the moment, clearly for their health, for their families, but in particular for their incomes. But a lot of our clients, the more sophisticated investors who, as you say, have multiple streams of income, who've lived through this before, who've got buffers in place, they're mad keen to take advantage of this stage of the cycle because they know that this is the stage of the cycle where they've made money before, Ken. But let me ask you the question again. Are we going to go into recession?
I think the answer is yes. I say that quite categorically. It was an iffy when we had the drought, the fires, but with Corona, when we're seeing such large numbers of people losing jobs, significant cash flow reductions, we will definitely, I shouldn't say definitely because we don't have a crystal ball. I would be extremely surprised if we don't go into a recession. It will be a little bit deeper and hurtful than it may have otherwise been a few months ago. So the issue is going to be, don't panic when we see the word recession on the front page. A recession means prices aren't going up as much period to period as they were historically. So knowledge is the key here. Knowledge is power. We've got to be knowledgeable enough to know that that isn't the scary situation of previous cycles. It won't be as deep. And more importantly, the government is throwing a bucket load of money to bring the economy back up once people are back in employment, once people can travel, once people can spend. So previous recessions, we haven't seen this mass influx of government money, can I say, from every government around the world. So that's going to bring us up faster than otherwise. And I think, therefore, we won't fall as deep as we would have otherwise. So don't be afraid of the word recession. It just means that economic activity hasn't grown from the previous quarter, and it hasn't done that 3 months and 3 months. So that's the definition of a technical recession, 2 3-month periods with falling prices. We know prices will fall. We know consumption will drop. With these prices, these activities falling, there will be a recession. I'm hoping it's going to be short-lived, and certain sectors of the economy will pick up much faster than others. And as you said a few minutes ago, people who are prepared to take advantage of the opportunities, not advantage of people, are the ones who are going to look back on this and say, that was a good time to make money.
Well, Ken, how is our banking system and just our economy in general, Australian economy, situated to cope with this sort of a hit?
The banks started off this in a very healthy state of affairs, very large profits. They were starting to lend again. Their costs of capital was coming down. The difference I see this economic cycle is banks may report profits, but they mightn't have the same cash flow as before, because if they're going to put moratoriums on people repaying interest, repaying principals, you know, the bookkeeping side of me says they're still going to book the profits, but they won't have the cash. Now, I'm not worried that they're going to collapse or fall down because their reserves are too big. Their activity levels are too big. And the government supports the banking system. So I think they're going to be ready to lend more on the other side of the economy, which is why they've got the strength to allow people to slow down their repayments, 6-month moratoriums, additional money for the business community. And between the Reserve Bank and the government, there's $105 billion worth of cash being put back into the economy. So that was a couple of weeks ago. So, you know, without talking too technically, the banks are buying back bonds to put cash back into the economy. And
Ken, I've got a note here from the Reserve Bank governor, not that he wrote it to me, but I wrote down what he said. And in his speech, he said, Australia has a strong financial system which is well placed to provide the needed support to business and households. The system has strong capital and liquidity positions, and our financial systems have invested heavily in their resilience. And as APRA confirmed, the current large buffers of capital and liquidity in the system are able to be used to support building the economy. So they believe the banks, it's not just you and me, believe the banks are in a good, sound position, and they've been given $90 billion lifeline with very low interest rates and told they've got to go out and lend, particularly to small business, because currently, and by the time some people are listening to this, the rules may be different, but Scott Morrison said rather than giving a handout to people like other countries have in helping their wages, the Australian policy is to help the employers, because if they keep the businesses going so the businesses can keep the wages going, it actually brings it up a level. So it's a different philosophy to overseas, but it seems to make sense to me because you can't allow the businesses to collapse. You can pay the employees for a while, but if the businesses collapse when it's all over, they've got nowhere to go.
That's right. And in the 91 recession, or in the 90s, I mean, it was a self-induced recession where activity levels were just going berserk and the government had to stomp it down in a big way. And we saw interest rates of 17.5%, and the list goes on and on. This time, the governments are forcing the reduction in activity to keep us safe, to keep us healthy, to keep us alive. But they're supporting that with a lot of cash so that people, as much as possible, can retain their jobs, to retain cash. And if they don't have a job, the safety net, the social safety net, is going to pick them up to at least give them cash flows to keep them, if you like, afloat until the health issues dissipate, and then the companies can go back into employing people. And, you know, we're seeing some of the major supermarkets, they're employing thousands of extra people. The government services, again, thousands of extra people to support this. So people are moving from a traditional job into these part-time jobs, or not part-time, they're short-term jobs, until they can go back. And we've never seen that before, which is why I think we'll survive. We just got to get through these next period until people are allowed, can I say, back onto the streets, and therefore confidence comes back, and then people start spending money again because they're out there in the economy.
Now, Ken, in previous recessions, as you said, it was due to huge excesses that had occurred, speculation, high interest rates, and led to high unemployment. It's very, very different this time around. And when that happened, a lot of businesses collapsed. It doesn't look like the coronavirus per se is going to make businesses collapse. And our government is hell-bent on preventing that happening because they now recognise they've learned from the past. They're dealing with it very, very differently to the previous downturns and the previous recession. They're wanting to keep businesses alive. It's that bridge that they keep talking about, getting us from where we are now to over there, a bridge for businesses, for employers, and for everybody else, for us as well.
Correct. And one of the big differences this time is we're seeing that as people have lost the revenue, their customers, before they still had very large outlays for rent, those sorts of things. Whereas now the government is forcing some of the bigger landlords to put moratoriums on the rent. So therefore, people will then have their shop to come back to and then start picking up the pieces. So we hopefully won't see a shutting down of businesses that can't actually reopen and therefore can't re-employ. So we're trying to, even if people don't have a job, we're trying to keep the infrastructure in place to pick up those jobs when the health issues dissipate.
Well, it seems like we're aiming for a deep but short, sharp downturn, recession, locking up, which will then allow us to have a quicker upturn. And while it may hurt in the short term, it's the only way we're going to get through things, because if we were locked up and businesses closed down for too long, that's going to create a whole lot of other problems.
That's right. I mean, it's that drip, drip, drip that, you know, I don't like to use the term death of 1,000 cuts. That's what will destroy. And that's what happened in that recession in the early 90s, where it took 4.5 years really for the economy to recover, because there wasn't the support to keep the infrastructure afloat. This time, with the infrastructure afloat, people can now come back in once the health issues are improved.
So the question you're probably wondering is, what do you do now? Well, we don't know your personal circumstances, And for some of you, you are going to run into some financial difficulties. So what I'd be suggesting is you speak to your banks, you speak to your mortgage broker. The banks are currently very lenient. They're not going to even give you a bad credit rating if you choose to have a pause or a reduction in your repayments. The banks are morally obliged, as is the government, to protect us at this stage, because this isn't anything you've done wrong. It's nothing we've done wrong. The government has forced us to go into hibernation, so it's got an obligation to us to get us through this, and the banks are on your side there. On the other hand, if you are in the position to do something, now is a good time to get set. So Ken, if people are interested in getting a strategic wealth plan, I know that's what you and your team do at Metropole Wealth Advisory. And if people are interested in understanding about property, that's what our team does as well. But to be successful moving forward now, you need more than the buyer's agent. You need more than the property strategist. I believe you need a holistic approach that incorporates financial planning, finance, property, wealth. You need to understand where you are now, where you want to get in the future, and formulate a plan. So it involves planning. And this is a great time to get ready so that you can be on that the trajectory moving forward. Ken, you were telling me something about compounding and the coronavirus.
We've seen that impact of compounding when 2 infections became 4, became 8, became 16. So that's the negative aspect of compounding. Imagine using that when you're building your wealth, property. So your property then doubles in value every 10 years.
Don't want average, Ken.
Yeah.
What we do with our perspective is get above average rates of return, because remember the statistics. There's 1.9 million property investors who own 1 or 2 properties and 23,000 who own 6 or more. So why not get the team at Metropole on your side? And Ken and I will be back during these challenging times with more regular masterclasses. And thank you for taking the time to listen to this. I hope it's given you some more direction, some clarity, and through that, you'll get the results that you deserve. Thanks for your time, Ken.
Thank you, Michael, and thank you, listeners and viewers.